Welcome to the continuation of our accounting cycle. Today we're going to look at step 5 of the accounting cycle, which is called the adjustment process. I would just want to mention here, this is probably the most difficult part of the course for students to understand, so make sure that you make use of this video and the other videos that I prepare when we do some adjusting entries together. Okay, so what is the adjustment process? We have to record all adjustments in the general journal, and they are referred to as adjusting entries. And this, like before, anytime we do any type of journal entry, does not matter if it's an adjusting entry or regular journal entry, we have to post any adjusting entry to the general ledger T accounts. And then we'll have to prepare an adjusted trial balance. So I think the most difficult part of this will be getting the adjustments down and how to record them in the journal. But I have some good kind of overview of some information you need to know about the adjustment process, and then we'll go through each of the categories to go understand them further. Okay, so let's see how this works here as far as the next one is concerned. All right, the matching principle. In accrual-based accounting, and that's what we have to follow here, accrual-based, does not matter when we receive cash or pay cash out, we have to record the transactions as we see fit. If we earn something, we have to record it then. It does not matter if we've been paid for it. If we have incurred an expense, it does not matter when we actually pay the expense. We have to record it when it is incurred. Okay, and along those lines, we should talk about the matching principle. And the matching principle simply states that you must match revenues and expenses in the period in which they occur. The reason we have to do that is because it will allow us to determine our proper net income or net loss during this particular period we're in, and we'll be finding out how to do that in the next step of the accounting cycle in step 6. So again, you must match revenues and expenses in the period in which they occur. So here are some basic rules for adjusting entries. First, they always take place at the end of the accounting period. So it'll be the end of the month, or if the month is, let's say it's the end of December, so it'll be just dated December 31st. If it was the end of June, June 30th, really the end of any month would be fine. And let's say you do a middle of the month end, as far as when you close your books, you could have it on the 14th or the 15th. That's perfectly fine. For the most case in this course, it's always going to be the last day of a particular month or a particular year. Okay, so let's see what else. Never involve cash. There's no exceptions to that rule. You will never, ever, under any circumstance, have an adjusting entry that will have either debit or credit to cash. And here's the key thing, and why it's probably the most difficult part of the course material for students, and that is you have to be so careful and kind of on alert on what amount you're going to need involved in your adjusting entry. So they could give you the amount, that could be possible, or you may have to make a calculation even though they gave you another amount. So you just have to really be careful, and I would suggest practicing this as much as possible to get this down. Okay, so here are the different types of adjustments. You have prepaid expenses, you have accrued expenses, accrued revenues, unearned revenue, and depreciation. And we will go step by step through each of these and give some examples. Okay, when we talk about prepaid expenses, we think of supplies, prepaid rent, prepaid insurance, and we think of those obviously when they come into the business, they're assets. And then when we use them up or consume them, they become expenses. So when you think about this, you want to ask yourself a question to focus on. How much has been used up or consumed? And when you get that particular number, that will be the amount of your adjusting entry. So they could give it to you two ways. They could say supplies used during the month was 500. Well, that would be the amount of our adjusting entry. We would use 500. Or they could tell us that supplies on hand were 500. Well, we need some more information than that and go find out how much did we start with to subtract how much we have on hand to get how much we consumed or used up. So you really have to be careful there. And then when you think of a generic sense for the adjusting entry, you would always want to debit the expense account, either supplies expense, rent expense, insurance expense, and then we would credit and reduce the actual asset, supplies, prepaid rent, prepaid insurance, because what are we doing? We are consuming or using up that asset, and therefore the expense is going to increase by debiting it, and the asset is going to decrease by crediting it. So let's take a look at supplies, and what I've done here is I've illustrated a scenario here, and for many of these this will kind of be the way it plays out. I'll give you a regular journal entry that we record, and then I'll give you an adjusting entry that we need to record. So in this first example, we are going to look at prepaid expenses, and we're going to take a look at the supplies. So it says on January 1st, we purchased $7,000 of supplies for cash. So the regular normal journal entry that we record in step number 2 of the accounting cycle would be to debit supplies, which is an asset for $7,000, and we would credit cash, which is an asset, and reduce that for $7,000. So again, supplies comes in, we increase it, and cash goes out and we decrease it. So then, if you look at what's the red stuff in the red writing, we look at January 31st. It says we took a physical count of supplies and found that there were $2,000 remaining. No other supply purchases were made after January 1st. Okay, again, the focus should be on how much was used up or consumed. So again, we purchased $7,000. We have $2,000 on hand. So therefore, we used up $5,000 of supplies. So that number, the $5,000, will be the amount of our adjusting entry. So our adjusting entry on the 31st of January will be to debit supplies expense for $5,000 and credit and reduce supplies because we used them up in the amount of $5,000. All right, and then we also can take a quick look at prepaid rent. We think of prepaid rent, prepaid insurance in the same kind of way here. So on the regular journal entry on May 1st, we paid 6 months of rent in advance for $12,000. So the regular journal entry on 5/1 would be to debit prepaid rent for $12,000 as an asset coming in, and we'd credit cash and reduce that asset for $12,000. So that's the regular journal entry. And then notice that really there's no information that we would have to be given. We'd really have to really know. Obviously, 1 month of rent has been used up or consumed because now we are at the end of May. So we would take $12,000, which was the total amount of prepaid rent or rent paid in advance, divided by the 6 months. So we know that the rent is $2,000 a month. So that's how much would have been used up or consumed. So we would debit on the May 31st adjusting entry rent expense for $2,000, and we would credit prepaid rent for $2,000. The next category we take a look at are accrued expenses, and these are expenses that have accumulated, okay, and we now owe them. So the common accounts involved in this adjustment would be salaries or wages expense, and you may also see interest expense as well. So basically what's happened is that the end of the accounting period has come upon us, and you've incurred an expense that you've not paid yet. So you owe that expense, and you must record it to be in compliance with our matching principle. So the generic journal adjustment would be to debit some type of expense and then credit a liability. In this case, you probably have to credit a payable account. So here's an example, and I can't stress enough to you when you think about salaries or wages expense to go ahead and do a little calendar. Should take another minute or two to figure this out. So it says here, the example that I prepared says December 31st, employees are paid for a 5-day work week, Monday through Friday. Payroll is $20,000 and December 31st falls on a Wednesday. Payday is each Friday. Okay, so let's think about this. So we know that $20,000 divided by 5 days would equate to a payroll of $4,000 per day. So you can see that calculation in the top right corner in black ink. Now, if we look at the calendar, we know that Friday, the 26th of December, the employees were paid. So we know that everything from the 22nd through the 26th was resolved and paid in the proper period. And we know that on the 27th and 28th, we don't need to worry about those days. Those are Saturdays and Sunday, and we don't need to worry about paying them because they don't work during those days. Now, if you look at the red 29, 30, and 31 of the calendar, you can see that those 3 days fall in December, and then you look at the blue text, the 1 and the 2 fall in the new accounting period, which would be January 1st and 2nd. The issue is that we're not going to pay them again until January 2nd, which is the new accounting period. So we have to properly allocate the expense for 3 days, the 29, the 30, and the 31st, the Monday, Tuesday, and Wednesday in December. If we fail to do that, we would not have enough expenses being reported in December, and therefore our income statement, when we get to step 6, would be overstated because we would have not enough expense recorded. So how do we record the adjusting entry? We would, on 12/31, debit the salaries expense for $4,000 per day times 3 days, or a total of $12,000. And then we have to credit salaries payable because we owe those salaries. We're not paying them today. Today's not the 31st is not a payday. We don't pay them until January 2nd. So we credit salaries payable, which is a liability, for $12,000. Now, if you look at the light blue entry here, I did add that in as an extra. This is not an adjusting entry. This is what would occur on a regular journal entry payday. Okay. So after we made the 31st adjustment in December, we obviously will run into the new accounting year, 2016, and we know that on the 2nd we have to pay them. So how do we do that? So we'd have to first pay off the liability by debiting it, salaries payable for $12,000. We know that the 1st and the 2nd are we're going to incur salaries expense for the first 2 days of the new accounting period. So $4,000 a day times 2 days would be $8,000 of salaries expense I must debit on January 2nd. And then we'd credit and give them cash for the full amount of the payroll for $20,000. Okay, accrued revenue is something that's, I think, pretty straightforward. The only thing here, if you're looking at common accounts involved, when you think about this, is service revenue or interest revenue. Basically, we have really earned revenue, but we have not yet recorded it. Again, if we would fail to record revenue in this period, in the proper period, in that case, you would understate your income statement when we get to step 6. So we want to make sure we have all the revenue that we have to record in the period. And basically, we're going to see that some type of receivable will be involved because we are owed the money. So the basic generic adjustment would include a debit to some type of asset or receivable and a credit to the revenue account. So here is a very simplistic example of both a service revenue and an interest revenue. So the first one's the service revenue in the light blue writing. November 30th, it says we finished a cleaning job for $10,000. The client has not been billed or the job recorded. Well, obviously, if we finished that job before November, the end of that November accounting period occurred, we must record it. So all we have to do, as far as the adjusting entry is concerned, on November 30th is to debit accounts receivable because we are owed the money, and we would credit service revenue. And both of that would be for $10,000. Now, another example will be deal with interest. And we could also say on November 30th that interest earned from the bank but not recorded or received was $75. Well, if we haven't recorded it or received it, we obviously are owed the interest. So in this case, we would debit interest receivable on November 30th for $75 and credit the interest revenue account for $75. Then we get to unearned revenue. Remember, unearned revenue is a liability account. We owe for services that were paid for in advance. Our common accounts involved really just two, both unearned revenue and service revenue. And the focus on this particular adjustment would be how much of the work that you were paid for in advance has been completed. So how much did we get done? Is it a percentage? Is it a dollar amount? So forth and so on. So the adjusting entry will always be set up like this when we think of the adjustment for unearned revenue, and that will be to debit it, the unearned revenue account, because we're reducing it. We're not going to owe as much services as we did before, and we would credit service revenue to record the fact that some of that or all of the unearned revenue that we had is now earned. So here is an example. On July 1st, we received $18,000 of cash in advance for 3 months of consulting services. So in this case, we do have a regular journal entry, not an adjustment we would have to record on July 1st. We obviously would debit cash for $18,000. That's the amount of cash coming into the business. And we haven't done any of these consulting services yet, so we would credit unearned revenue in the amount of $18,000. So that would be the regular journal entry that we would do. Now, let's see what happens on July 30th. They tell us that we earned $7,000 of services paid for in advance on July 1st. Okay, so now we no longer still owe $18,000 of services. We only are going to owe, after this adjustment, $11,000. So to be able to record this properly, we would debit unearned revenue for $7,000 and credit service revenue because we did the work, and our regular service revenue account is going to increase by that $7,000 figure. Now be careful here. In some cases they may give you an adjustment data that says unearned revenue still unearned would be X amount. Well, you'd have to do a calculation there to make sure you got the amount that was earned, because that's always the amount of the adjusting entry. Okay, then we get to depreciation. This requires a little bit more as far as background information. Basically, when we think of depreciation from an English perspective, we think of loss of value. That's really not what we're looking at here. It plays a role, obviously, here, but not specifically for what the accounting definition would be. Basically, depreciation is the allocation of a plant asset's cost over its useful life. An example would be this. If I'd buy a building for $500,000, obviously, and I had to pay cash, I would debit building for $500,000 and credit cash. Now, the thing that we have to be careful is we're not going to incur a $500,000 expense in that one period. That would really be difficult to overcome such a large expense. So what we have to do is we're going to allocate that cost over its useful life. Key thing here about depreciation is that it's an estimate. It's also a non-cash expense. Remember, there's no adjusting entry that has cash in it, so we know that we have to kind of understand that this will be a non-cash expense that we're dealing with. For now, we'll stick with the straight line method, which the formula for that is cost minus residual value divided by estimated years of useful life. And you could either refer to as residual value as that, scrap value, or salvage value. All of those three terms mean exactly the same thing. And that really refers to the book value of the asset after it has been fully depreciated. And remember, that's going to be an estimate. Okay, so let's say we buy a delivery truck for $10,000. I estimate that at the end of 5 years, which is the useful life, it'll be worth $1,000 to us. That would be referred to as the residual value. And then when you also, if you look at the numerator of the straight line method formula, the cost minus residual value, that's referred to as the depreciable base or depreciable cost. And that is the maximum depreciation allowed on that particular asset. So, how do we do the adjusting entry? Well, we need two new accounts here. We're going to debit an account called depreciation expense, and then you have to list the asset that's attached to that. So if it's a building, it would be depreciation expense building. If it was a delivery van, you would debit depreciation expense, comma, delivery van. And then we need a new account, and it's kind of going to be a little bit of a difference, throw a little bit of a wrinkle as far as our debit and credit rules. It's called accumulated depreciation and whatever asset we're depreciating. So this is a contra asset account. It will be linked with, it will still be in the asset section of the T accounts, and it will be directly next to whatever asset it's working with. So if we had building, you would see building, and then you'd have that T account, and then directly underneath of it or next to it, we'd have the accumulated depreciation building account. Notice that it does not have a debit balance, it has a credit balance, and the reason that is because we're going to have to calculate the asset's book value. And the way we do that is we take the historical cost of the asset minus the current amount of the accumulated depreciation, and that will give us the book value of the asset. So I'd recommend making some T accounts for the new accounts you've seen today, especially depreciation expense and accumulated depreciation. Add that to your note cards that you hopefully did in the quick tip video from earlier to learn the debit and credit balance rules. Okay, I'm going to stop here, and we'll go ahead and we'll work on doing an example. We'll continue the comprehensive problem exercise to go through how to do adjusting entries.